Okay, we are recording. It is February 8th, 2024. I'm Tim Quast. This is the Market Structure Edge live demo and discussion. Along with me is Brian Wilson, market strategist. And once again, we're going to tag team this. As often as I can convince Brian to do it, we do this so that we can present two perspectives for you. And I think it's very helpful. You know, he's a longtime buy-side trader. I'm just an IR guy, investor relations. We're data analytics folks, but I think that two different perspectives are helpful. Okay, so I think I've drawn the short straw to go first, right, Brian? So I will tell you what I'm planning to cover, and I think we each have three things. I like to talk about the mechanics a fair amount, and I'm going to do that again. I'll give you a couple of examples. I'll share the things that I do. If I make mistakes, I'll tell you. I'll tell you the things I encounter because what I'm trying to do is minimize mistakes. If you can keep your gains and avoid declines, and you can't ever do it perfectly, that is the optimal outcome. It's very much like in baseball, the on-base percentage. You want to be on base a lot because that's how you win games. And so I will give you some examples about that. I want to talk a little bit in context about the time of day to do things. Look, it's not perfect. They're just general, I would call them mechanics of the market, part of market structure, general things that occur at certain times of the day. Then I want to talk a little bit about the preliminary data that we're developing that we'll soon make this available on the platform that give you entries and exits. You know, it took us a while. You have to do a bunch of data science till you're comfortable sharing those things. I have a model I use all the time, and I've shared that. Third, I'll talk a little bit about trends. The difference between day to day, you listen to CNBC, and every single day is a new day in the markets, and it's not the way that the market works. It very much has a cadence and calendar. There are things that passive investors do. There are things that long-term investors do. There are things that short-term investors do, and there are things that people do to hedge or leverage exposure. And there's a method to that, and it's not new every day. And so we can kind of see those things in trends. That's the plan. So I'm going to share my desktop here. Bear with me a second. Okay. And whoops, there, that worked. Okay. There was a hesitancy. All right. So if you're new to Edge, and most of you, I think today are veterans or at least somewhat familiar with Edge. But if you're not, this is the dashboard. And I always say what you want to look at is broad market sentiment. What is the big trend? Because most of the money in the market, if you look at this mathematically, something close to 70% of the invested assets are now following models. Sometimes it's stock pickers who just mimic what those models do. Closet indexers, they're called. So it's very important to know what that overall trend is. I look at low volatility, how many are in it, what's leading it. Momentum, same thing, how many are in it, what's leading it. I like this is not on the platform, but you can do it very easily. And it's just all, the criteria in here is there's one criterion: market cap equal to mega cap. It's all, because I just want to see where the $35 trillion of assets are that most of that passive money is concentrated in goes, and then big tech. There are other things. You can do all kinds of things with this data. If you trade cryptos, I don't, but you could with this. If you see demand falling and supply rising, probably you don't want to be in Bitcoin. When they reverse and demand rises and supply falls, then you want to be back in Bitcoin. And it's a very good way to modulate your exposure to Bitcoin, because these stocks are the ones that are, focused on that part of the market. It's not a perfect representation. This is not something I was planning to cover, but I'll just show you. Again, I'm qualifying by saying it's not something I do. I do it for information. Here's a set of stocks that are focused on the cryptocurrency market. And so it's just a way, it's a way you can see what everybody else thinks. is it shows up in supply and demand. Okay, so let me get to mechanics. And by mechanics, what I mean is, okay, if you're looking at all this data, then what? Then what do you do? And I'll give you two examples. So let's take for the broad market first. Suppose that you just want to trade the broad market, something that I did Friday and Monday, and it's not because I did it. It may or may not work, but we want very high probabilities. We're not guessing or gambling or flipping a coin. We're trying to make sure that we follow the math and understand what it indicates. Once again, for new folks, this is market structure. Everything we have done is predicated on the regulations that govern how the market works. What does a broker dealer have to do with your trade? Well, it's heavily regulated, has to be handled in a certain way. You could go all the way back to 1997 with the order handling rules, and those things propagated forward through regulation national market system. And an order that you handle is a trade. Well, what happens with that? Well, today it gets routed around the national market system, and it has to be executed certain ways. And we can knowing that is important. How are prices set? Prices are set by whoever gets to the bid or the offer first. It's a time priority market. Who's that going to be? The shortest horizon. Why? Because they're fastest. But their investment horizon is shortest too. So know that some short investment horizon is going to set the bid and the offer, and your trade's going to have to be between that. So then we take a long step back to understand the supply-demand balance to know what may happen, not in the next few seconds. You cannot win that game, but maybe later today, maybe tomorrow, maybe in the next 3, 4, 5 days following that. I say that for trading purposes, edge is very good 1 to 5 days, because we're going to try to be in a place where we don't have a lot of competition. You can also use it long term by modulating your exposure to the market using broad market sentiment. So here's what I wanted to show you. If you were to look at the market last week, so if I just wanted to see, whoops, I did that wrong. So I'm going to pick this up, scroll forward. Let's suppose I just want to look at where it was, where the market was through Friday. I think I got that right. Yes, I did. Okay, so I'm looking at supply and demand on Friday, and I see, okay, well, the market's doing pretty well today. That day it was way, way, way up. But I see that supply has risen. Now that is not a trend. That is a one-day change. That's all it is. However, that can be meaningful short term, because probably machines are responsible for that. So I shorted the market at the end of the day on Friday because it was way up. Now, why you say, well, that seems wildly risky, Quast. Why would you do? What if it goes up another, 100 points? Well, it could, right? So you have to have some, you have to have risk management parameters, stops and limits, and they're not going to be perfect. Make sure you have an algorithm enabled to get you out. I don't want to lose more than 1%. That's kind of my floor. And I can stay right there. Before I learned that, back up a year, and I hadn't learned that, it didn't work out that way. And I had 3 bad experiences that I have not duplicated by making sure that I'm very careful about not risking more than 1%. If I get stopped out down 1%, I hope it's less than that. Well, fine. I don't like to lose money, but it sure beats losing 5%, doesn't it? You can always come back and make a good decision. So I shorted the market on that Friday. Then we'll go back and step forward, because now I'm trading the broad market, and I used a leveraged ETF. So it'd be SPXU. There are all kinds of instruments. I like to trade TQQQ, SQQQ, because they're the core part of the market. And those, but again, I'm very careful. I'm going to only do those when I look at big tech, large caps, the broad center of the market. Is it moving in my direction? And is the market not reflecting that? If the market is not reflecting what I know to be the trend, there's an opportunity. And then just take your gains. So then on Monday, what happened on Monday? So that would be here the 5th. Well, the market declined sharply, really sharply. So within an hour, I had made, I made 1 or 2%. I took my 1%, very happy with that. And I shifted long a little bit after that, but I shifted long. I said, why would you do that? I mean, how do you know the market's not going to continue to fall? Well, I don't. But remember, one day is not a trend. This is a trend. Now we have a trend where the supply side in the whole market is rising. 3 or more days is a trend. I mean, statistically, maybe a very short trend, but one day is not. So if I say one day it ticks up, but demand is still at 6 and it's just, I didn't even know if it was plateaued yet, right? So I know that the market probably is not going to stay down. It's probably going to recover. Then if I go look at SPY, what was SPY telling us at the same time? Okay, so if we backed up to, so there's Friday. So Friday told me, demand is very, very good. It's 5. SPY is going to be 5 because it's the market. What is the market principally? Well, 50% of assets are passive large cap blend. That is, they're large caps and they're either value or growth. Well, what would that produce? 5. It would give you exactly the balance in the market. And so then fluctuations in supply create runs in the market. So I look at this and say, well, actually supply fell and demand stayed level. And that's where we were Friday with that. Well, that's certainly not a downside signal. So I was very comfortable reversing my trade, figuring, well, probably the market will recover. And sure enough, it gave me another 1%. 1% short, 1% long, I'm out. And that's good. I don't look back, don't think about it, don't need to hang around. I can go do other things. That frees up the day for other activities. But that's those are things to know. I would not have known if I did not know the supply demand balance everywhere. What are people doing in the ETFs that are substitutes? What are they doing in the underlying stocks that'll be in broad sentiment? What's happening in the parts of I can look at the entire market on my dashboard, every sector, every part of the market. What was in momentum on Friday and Monday? You can look at that stuff. What's in it, what's in low volatility. They're not highly correlated to the way that the market works. But what they tell us is if we can produce 1 or 2%. I say this is 1%, might be 50 basis points. And I'm going to give you another example. And then I'll wrap up my portion so that Brian can get to his. Here I'm looking for 2. Why am I looking for 2% in momentum? Because they have at least 3% volatility. It's one of the core criteria to be included in the momentum portfolio. They must be 8 or more. Could be bottomed or top. I prefer stuff that's rising or is at 10, but if everything's moving up, you can capture. If the broad sentiment is turned, you probably don't want to buy 8 and bottomed. Why? Because the probabilities diminish. But it's math, and it's going to give us great, awesome probabilities, and then less awesome probabilities. And then if you look at volatility, that's the amount. The way we think about that is intraday volatility. There are other terms I know for it, but we think about the spread between the highest and lowest average. It's a 5-day rolling average here that we use. And so I like to trade the stuff that is most volatile, because if I can take half of that, I get a nice return. Machines are going to give you some portion of it. Machines determine this. Machines that have investment horizons of 400 seconds, 400 milliseconds or so, I'm just using a round figure, that's a blink of an eye, will calibrate how much they're willing to move price to absorb all the stuff that is below what you can see. Non-displayed liquidity. There's a lot of it. Your limit order becomes non-displayed liquidity. So it's sitting out there, and an algorithm could come through and find it, because it is an order waiting to be executed. There's a lot of non-displayed liquidity at the stock exchanges. They sit just out of sight. So if you see 500 shares at the bid or offer across the market, maybe it's 5,000, there could be a lot more that you don't see because it's not within the best bid or offer. It's below it. Whoa, that's all the iceberg. It's there. And so machines know, okay, to hit a supply-demand balance that gives me a tenth of a penny profit day after day after day after day per share, this is what they're willing to move the price. Well, we can use that to our advantage. If we know there's excess demand, insufficient supply, this is how much things will move, we could go calculate what we can do, which leads me to example number 2. So I also traded GIS. So because there are more components in the low volatility portfolio than the momentum portfolio, and I know now demand is falling, supply is rising, now I might go to low volatility and reduce the amount of money that I'm trying to generate. So if GIS closed at 64.83 yesterday, let's say, just as an example, and it has volatility of, call it 1.7%, half of that would be about 90 basis points. I could take a little more than that, depending on what it's doing. And then what I'm just going to calculate is, okay, well, what's 80 basis points up from that? Well, 64.50. So if I could buy it at about 64, down, here it would be 1.3%. If I could buy it around 64 and sell it at 64.50, staying within the range that I know the machines will give me, and I know its demand is fine, supply had fallen, well, I'm happy with that. And what kind of risk am I willing to take? Well, if I buy it yesterday and sell it today, which I did, that's really nice. I made one mistake. I really bought it too soon. I should have bought it in the last hour. Why in the last hour? Because in the last hour, a lot of that volume it's passive money wanting the reference price. And all the machines know it and are going to go change all the prices to try to create the average price that all the indexes and ETFs need by law to track their instrument. They need that. In the first hour of the day, all the machines are exploiting supply-demand imbalances. All these orders come in, then some of them will be at the market and some will be at limit orders and all. 98% of it at least, if it's not more, it could be very close to all of it, is on algorithms. Your orders are on algorithms. If I hit a button to buy or sell, as I did, I had 795 shares of GIS. If I'm gonna sell it at the market, it's gonna go boom. It could break into many trades. It could be that my own broker has to take the other side of the trade, which they did in this case. But it's an algorithm that's going to execute that. Well, so in the first hour, I know that's what's sorting out. It's the stuff coming in, the stuff that needs to get out. All the rest of the day, basically call it from 9 to 9:30, somewhere in there, all the way till about 12:30, close to 1. That's the Wild West. I mean, you might have great opportunity like VRT. If VRT a couple days ago dropped half of its volatility, and then during the middle of the day, it gives you 3%, take it. I mean, it's just perfect. Just APA did the same thing a couple days ago. Patchy, if it's down half its volatility early in the day, because there aren't orders, but the supply demand balance, the volatility, and then it gives you 2%. Take it. It's just perfect. You don't have to do anything other than that to see your account value go boom, 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 boom. That's what you want to do. So those are important things to know about how the market works and how I think about it. And so I should have bought that right toward the end of the day, and I could have gotten a full percentage point today. But I had high confidence. You could say again, well, how do you know that GIS isn't just going to continue down? That's General Mills. Well, I don't, but I have a high probability just based on the supply-demand balance. Everybody else doesn't know what I know. I know that it's got very solid demand. Now supply is starting to tick up, and it's got some volatility. So is there a high probability that it will reverse part of this? Well, yeah. It's a high mathematical probability. I am not gambling. I'm saying that the probability north of 70% is it's likely to rise just because basic buying and selling is occurring and there's insufficient supply. Well, just those things continuing with no thought will cause the price to rise. Not much, maybe, and then you take it and you move on. So I did. Those are examples, and that's how to use the data. Very quickly, I want to show you something about the data. Sorry, wrong one. This is what we're doing with data, by the way. This is what we will ultimately have on the platform, and we're getting close. It is probability, volatility, entry price low, entry price high, exit price low, exit price high. So if you were to buy somewhere in here and 1 to 5 days from now, sell somewhere in here, that's your aim. That's what you want to do. Sometimes there's in the trailing data, Sometimes it's 100% probability. Their past performance is no guarantee of future outcomes. But if you looked across this, and I could sort it by probability, the worst in this case is flex, which is in the momentum portfolio. There's a 33% probability that you can produce 2% 1 to 5 days from now. Well, find something else, right? I'm not going to trade that. But if it's got an 81% possibility, I think that's what is that? That's Estee Lauder, which had a great quarter. That could distort it. But an 8 out of 10 chance, if I buy somewhere in here that 1 to 5 days from now, I can sell it somewhere in there and produce some portion of that. In that case, it's what is it? So that's momentum. So 2% is what I'm after. Can I take half of that? That's what we're after. This is not. We're not here to tell you this thing is going to go up 1,000%. That is not what we're trying to do. We're trying to take the mechanics of the market and take things that we can count on consistently and don't lose money to the best of your ability. You can't control that wholly, but you can do a pretty good job. Last thing, really, I've covered trends. So Brian's got some very important stuff to cover. So I am going to stop there, and we can answer questions, but I will hand it over to you, Brian.
Hey, Tim, could I jump in there for 1 second with
Please do, John. Nice to see you.
Could you pull?
Nice to hear you.
Yeah, not on camera, but good to see you guys. Could you just pull the GIS thing back up? I got a question for you.
Yeah,
I guess
absolutely.
Covering everything you just showed, right? So
okay,
if demand has been 5, right, since the 25th, you see supply coming down.
Yep.
And if you look at a stock chart of that, right? So basically it's traded in a range, let's call it up to 65 to 63, but the 65 was barely touched and the 63 was barely touched. So basically what demand, you're saying demand is that basically there's a steady bid in the market that is looking to over this time frame buy the average price, like what the VWAP is basically.
Yep.
And then what you're saying is that based upon that data, we know what the volatility is, right?
Yep.
If you're looking at that kind of medium price, which is around 64, this thing opens up down its volatility like it did, today, right? Today was it was yesterday, sorry.
Yesterday.
Today,
it was
sorry,
weak
Thursday.
Today too. But then boom, it recovered, right? So
but look at where did it trade right back to? The VWAP, right? And then I would say the VWAP probably since the 22nd basically is what I'm seeing. So I mean that is in essence what you're showing here, what you're saying, like when demand's steady like that, it just means there's this constant bid that is moving the VWAP or your average price up over time or over the next 5 to 7 days. And then we know basically the volatility is telling you that price will advertise above and below it because that's what the Citadel and the high frequency guys are willing to transact based upon the order imbalances. And to your point, there's the open auction in the morning, and then there's what needs to be done at the end of the day because everyone needs to get close to these prices. Is that the essence of what you're saying and seeing here?
It is, and the only qualifiers I would put on that, so I would call it 80, somewhere between 85 and 90% of orders are a derivation of midpoint. Could be VWAP, it could be TWAP, a time weighted price, could be peg, could be floating. There are all kinds of ways to get there, but it comes to, so the only reason I don't say, well, why wouldn't you just look at the VWAP? Well, because the VWAP isn't what a high frequency trader is after, and high frequency traders, I'll share this. Here is SPY's composition of daily volume over the trailing year. So 11% of it is active investment. Probably that money is going to use midpoint prices. 27% of it is passive. That could be quants. Indexes buy this. ETFs buy their own stuff because it's so much more liquid than the stocks. So so you can put these together and say, well, what is that? Call it 40% of the market at least wants a VWAP or some form of it. High frequency traders, fast traders, 43% here, much lower than the average stock, which is over 50%. They're going to be putting in market orders most of the time, boom, 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 because they don't want to be seen, and they're willing to take a tenth of a penny crossing it, right? So you set the bid and the offer, and then you cross it. Derivatives, different deal. You know, if your trade is tied to a derivative, then what you do with that is really dependent on the value of the derivative. But yes, ultimately, when you put it all together, what you're seeing is these different purposes and time horizons competing for their interests and causing some volatility that permits us to capture part of it. Yeah. So you're exactly right, though, John. I get your point. John's pretty good with data.
Mm-hmm. Hey, Tim, there's a couple questions out there for you.
Okay. Thank you. CCJ, I have not looked at that. I will take a look. Do you look to take 2% for previous close? Well, it's a good read, but it's from the entry point. It's from my entry point, right? So so the closing price, if it's down half or more of the volatility, then what if I want to make 1%, what's the move from that? That just becomes my aim. It's not exact, you know, but it's pretty good. That's exactly though what I did with GIS. I knew it was about 64.50 that I needed to be at, and I think I sold it at 64.53, a little better than that. Let's see, okay. Do you make your Excel calculation based on the prior close? Yeah, no, that's gonna be my peg. And you can say, well, why that? Well, it was the last reference price. You know, the closing price of the day may be the 15,000th price, or in the case of NVIDIA, it's the 800,000th price of the day, because it trades 800,000 times a day. And by the way, 95% of all orders are canceled. So really, there were millions and millions of prices for NVIDIA, but the last price of the day is the reference price. That is the price that indexes got. And they're 70% of assets, indexes, ETFs, quants. So that then is a reasonable place to begin from if you're calculating your volatility. There's nothing perfect. It's just a way to think about it. Okay, I've eaten up all Brian's time, so that means he gets it all next time. But go ahead, Brian.
Sounds good. Thank you, Tim. And apologies, my dogs are barking in the background at something. So if you hear some dogs, just consider yourself right at home. I did want to cover just a couple of things. I mentioned one of them in a note a couple of days ago. So I'm going to shift over to the dashboard here for a second, broad market sentiment. And what I want to show is just what happens when conditions move above the red line. So when you'll see two areas here on the graph. Green line, market's basically becoming oversold. What we want to talk about right now is just what happens when you move above the red line itself. And you'll see this happen periodically during the course of the year. You can see that we moved above it back in November. You'll stay above it for a period of time, move back above it. It's just the natural rhythm of the market itself. Well, you can see we briefly moved back above it here just a couple of days ago. What I wanted to share with you, and I'll move this out to a longer term picture. What does that look like? So when you move back and forth above that red line over time, what does the market do when it's above that red line indicator? And the way I like to think about it, I like to think of that as the market becoming a little bit overbought or just a little bit stretched. And what I did is I ran a 4-year exercise. Let me get the dates here. So, and I'm happy to share this spreadsheet with anyone that would like it. But on a 4-year basis, red line to red line, this was 2020 to 2023. The average returns 70 basis points. So in other words, and that's the average time above the red line. If you stay above it for 2 weeks, what is the market performing during that time? When the market gets a little bit stretched, about 70 basis points. Now, it does differ a little bit in different conditions. During 2022, when we were basically in a bear market, well, the market lost 70 basis points. During 2023, when we were in more of a bull market, the market gained about 1.5%. But one thing that you can tell over time, that's the market gains kind of start to slow down a little bit. How could you use that to your advantage? Well, there's different ways that you could think about it. That the market returns are going to slow a little bit. One way that you could approach that, if you like trading in options, if you go above the red line, you're like, oh, my average time above the red line is going to be about 2 weeks. And I know that, the average returns are 1%, give or take. I could sell a call. I could sell a call knowing that the market shouldn't go, more than about, 100 basis points beyond where we're at right now. So just different ways to think about the data. Of course, as Tim mentioned, past performance is no indication of, future performance, but that's what we're seeing in the data. Once again, when you move above that red line indicator. I did mention today, wrote a little bit about the SPY and how we're starting to get a little bit of a normalization in terms of that data. Let me take you back a year to show you what we're starting to see here. Long-term average, when we look at short volumes for the SPY, average is about 55%. And this is just going back 1 year. But you can see that in the latter part of December, we started to have a real outlier in terms of that data. What we're starting to see now, and this is as of yesterday, it could shift again, but we're starting to see that SPY move higher. In fact, it got north of 50% with yesterday's trading. What does that communicate to us? Well, maybe this big period, this outlier period that we've seen in the market, maybe that's starting to come to a close. And it might not happen today, might not happen tomorrow. Part of the reason for that, you look at broad market considerations, we're starting to decline right now, but we're still at 5.7. So when broad market sentiment is still above 5, you have residual demand in the market that is generally going to, carry the market forward for a period of time. So that SPY starting to normalize, just kind of something to watch as we get closer to expirations. And then for me, the last topic today is really, what's ahead. And what's ahead from a context perspective will be coming up on options expirations next week. We know that can sometimes distort normal trading. What would we say right now if we were to just look at this, is going to happen with expirations? Well, we're having declining demand, we're having increasing supply. That's generally going to be poor in terms of market results. Here's a qualifier to that statement that I just uttered, though. Look at what's happening in two portions of the market, which might dampen, what would normally be, let's call it downside. Look at what's happening in big tech. Covered in big tech. So we had a period where shorts just started to go a little higher. They're once again starting to get covered. And also look at what's happening. I have an all equity. If I knew my alphabet, I could go there automatically. All equity portfolio. Think of it basically as the Russell 3000. It's everything that we're tracking. And I don't know why that's being so slow. Maybe I'll go back to the front page. There it goes. Okay, so what we're tracking in the all equity portfolio, it's going to look a little bit different than the S&P 500. This is also on a daily basis, but essentially the Russell 3000 has slipped below neutral, but also notice what's happening with short volumes there. Just like big tech, they're also starting to decline. And Tim mentioned it earlier. This is only 2 days, doesn't make a trend, but what I'm potentially seeing is short volumes starting to get covered. Might dampen potential downside volatility. Going into options expirations next week. So I think that's what I wanted to cover, Tim.
Okay, thank you very much, Brian.
Yep.
And that's what gets us very close to time. Let me drop one thing. Martin, I want to address your question really quickly, just in a matter of seconds. I'm going to put this in the chat. I just reminded of this. I have an IBKR webinar on Valentine's Day. I'm not sure how well that's going to go over with Karen, but it's at it's at noon, right? It's at noon my time, 2 p.m. Eastern time on the 14th, Wednesday the 14th, next week. So it'll be right into options expirations, and it's called "Why Monthly Options Expirations Are Landmines for Traders." So I'm gonna go through some things you should know about what happens during these periods of time. Of course, many of you know this because we talk about it a lot. But if you don't know, and you've experienced losses around monthly options expirations, this might be helpful. So I mentioned that. So Chris, to your question about CCJ, very quickly, they reported results. So it's one of the things, three big things that can change outcomes. Earnings can change outcomes because there are big derivatives bets. They show up in demand and supply. The problem is if 20% of implied demand is from derivatives, like say call options, and then a company reports results and all of a sudden the stock gets repriced by whomever, it could be a machine. Now those options get marked to market, which is zero. And that's how a stock like Snap can go down 30%. It's not because investors cut off their noses to spite their faces. It's the fact that all the derivatives bets get reset. So is CCJ down 5% today? You could say, well, isn't that a great opportunity? All bets are off. You can't rely on what supply and demand say now because it has been recalibrated. The other two big things that do that, options expirations and big macro events, monetary policy, that unfortunately those treasury auctions, stuff like that can reset the value of the derivative component. And just tell yourself, every time you look at the market, 20% of market cap depends on a derivative. Most of the time, only a small part of that gets reset. And so you only see a 1, 2, 3% effect from those large things. But it can be very significant. So I just want to point that out. I would be much more interested in, I'm not saying, we do not give recommendations or investment advice, but I look at CMS in the low volatility portfolio. If it's down half its volatility in the next, still, I might buy that today because there's a probability of a 50 basis point return tomorrow. I don't know. I haven't looked at it yet, but it did catch my attention. I just mentioned it. You say it's a utility. Why would you do that? Well, I'm after 50 basis points. It's in the low volatility portfolio. Okay, good enough for today. Okay, that was plenty. We'll do this again on is it the 15th? I think so.